Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today, way back in the month of April or May, sometime around that time, when he joined on this very show, had mentioned that COVID was not the pin that would prick the bubble, but it's actually the accelerator that the world economy needed, or indeed the Indian economy needed. Those words were prophetic in that sense. The question is, has that changed now that we are in the midst of the second wave, with the possibilities of God knows how many waves coming up? And what does that do, if at all, to the market's thinking? Because frankly, while we're in the midst of or just out of a very severe second wave, the equity markets have gone about unfazed, and maybe rightly so. Let's call in the guy who actually spoke about it in that way in the last time. Ravi Dharamshi is the one that I'm talking about. He needs no introduction, joins us on the show today. And Ravi, that's my question. That's how I'm starting off. While those words turned out to be true, and I hope everything is fine, by the way, with you and family, what is your sense right now about what kind of issues or what kind of opportunities can this health scare around India create for the investing fraternity?
Yeah, thank you, Niraj. Thank you so much for having me on the show. Yes, at the outset, let me wish you, your family, and your viewers and your family safety, and hope they are in the pink of health. We are in the midst of a human tragedy, so talking about economy and market sounds a little bit out of touch and inhuman, but such is life, and markets being the discounting mechanism that they are of future cash flows, they don't have a human or an emotional side to it. So taking that into account, let's go right to your question. So I think as we spoke last time, clearly COVID was an accelerator of trends and not the needle that pricked the bubble. But second wave of COVID is even less so. And the reason I'm saying this is because when the first time around it happened in the month of February, we were completely taken by surprise. And I'm talking about surprise from the market's point of view. I'm not talking about actually everybody was surprised, whether it was the government or any healthcare worker. Everybody was taken by surprise, had no idea what to expect. It was a complete lockdown versus what is happening right now is maybe partial and local. There was no vaccine in sight at that point of time. Today, there are 8-10 options of vaccines available. Yes, there are supply constraints, but it is not like it is going to remain like this forever. In a couple of months' time, even the vaccine situation will ease. Also, besides the vaccine, there are other drugs and other tools that will be available soon enough in this battle against COVID. So, and the second level thinking that was missing during the first wave was that the central banks and the governments will provide a safety net, a stimulus to get the economy moving. So first wave was totally unexpected, immeasurable, and no idea how long the duration it would be. The second wave, on the other hand, is expected, it's measurable, and we have some idea of how long this will last. So the impact on the markets incrementally reduces to that extent. And in fact, I will go a step further to say that there will be no third wave. Now, I'm not saying that the virus is going away. What I'm saying is, from markets' point of view, there will not be a third wave, so to say. Obviously, the healthcare infrastructure needs to prepare for the worst, and but that does not mean that the economic impact of that will happen. I think incrementally, I mean, the same example I'll give the last time I gave. Brexit in 2014 was a big issue. By the time it happened in 2019, actually, the Brexit was far less of an issue and market did not even think twice about it. So that's exactly what is going to happen. And if at all there is a third wave. In fact, medically, I believe even the third wave can become less likely, as you know, there is a very promising drug that is on the line that can actually take care of the pandemic.
Fill us in. You are a pharma expert. Just very quickly, what is this drug that you are referring to?
Yeah, so I think there's a drug called MOLNUPIRAVIR. It is being talked about
NATCO.
As the NATCO is one of the few ones, but it has not had a tie-up with Merck, which is the innovator. So there are other 5 companies that have signed a licensing pact with Merck. But the point being that this drug molnupiravir is an orally administered drug as against remdesivir, and it is known to remove the infectiousness and disease from the phase 2 clinical trials done by 100% by the day 5. And it is not a drug that is very difficult to manufacture. All we need is scalability. So if you can identify a person with COVID early in the stage, then a simple drug therapy, a 5-day course of taking 2 pills per day can cure you of COVID. And this, I am hoping that Government of India approves this drug, and the phase 3 trials data is encouraging enough, just like phase 2. Phase 2 was conducted on ferrets, and ferrets have the same lung structure that humans have. So there is a high hope that this drug will eventually see the light of the day, and it will be very effective on non-hospitalized COVID patients. So if that were to happen, so now to give you an example, if one person in your family gets infected, all the rest of them can take that particular drug as well to prevent the infectiousness. One person got contracted, he will be cured in 5 days, while others might not get infected at all. So this is one more weapon in our armory to deal with this virus, along with vaccines and many other things. We are also augmenting the healthcare infra and oxygen and ICU beds and pediatric ICU beds. So what I am saying is the third wave, we will be way better prepared than we were for the second wave, and we will have better arms and ammunition to deal with this crisis.
Okay. So, well, cross all 20 fingers for that. In fact, 40 if the two of us are put together, right? Let's cross all of them.
Absolutely.
Yeah. So Ravi, from an investing perspective, last year, right, the differentiating factor between economies, governments, nations, what have you, was because everybody was on the same footing when it came to COVID per se. I mean, how they dealt with it, lockdowns is separate, but nobody had more vaccines or less vaccines, so to say, right? Nobody was vaccinated, and therefore the amount of stimulus that the central bank or the government or combined could give was probably the differentiating factor. This time around, even the quantum of vaccination done is a bit of a differentiating factor, right? So how do you view we'll get to the micro, Ravi, in a bit, because I would want to talk to you about how are you doing stock picking in such a scenario, because that's my principal interest. But I still want to understand from you, how are you looking at the macro too, when it comes to this perspective?
Right. So you're absolutely right. So last time around, the amount of damage that would be caused to the economy was an unknown, and governments took some time to realize. But I think they acted fast enough and provided all the necessary support that the economy needed. Obviously, now it is very clear that some of the developed economies have probably overstimulated, and we are seeing that in the inflation that is happening across asset classes, materials, everywhere. Essentially, the money is getting devalued against every asset and everything. So to that extent, the response in the second wave or going forward is going to be measured. See, in March, there are very few times in the markets when the odds are so much in your favor that one should not use the thimble, as Warren puts it. You should use a bucket when it is pouring. So, but obviously now 15 months down the line after a fantastic rally and fantastic returns, the odds are not the same that they were in March 20. So, but that is not to say that we are on the verge of an imminent crash. So I think the central banks and the governments of the world will still continue to keep their policies loose, still continue to stimulate the economy. They will keep focusing on the data of job creation, and they will try and ignore the inflation threat, as they have already put it, it's transitionary. Now, I have no way of saying that whether this is transitionary or not. But my job is to look at what Fed is doing, and what Fed is, or for that matter, any other central bank is doing, is looking through this inflation. So I will keep looking out for danger signals from bond markets if there are any. But even after such huge stimulus in round one, where we are already touching the World War II kind of proportions, the bond yields world over have barely reached the pre-pandemic level, or in fact, some of them are still in the negative territory. So I don't see panic everywhere, especially in the bond market. So I feel if the inflation was to manifest itself, it will first get reflected in the bond markets, and then equity markets will react to it. At this point of time, I don't think bond markets are reacting to it as well. So just to sum it up, 2013 to 19 was a cleanup phase. We were kind of stuck in this vicious cycle where the economy was just not reviving. One after the other, even the steps taken to reform the economy were turning out to have a negative short-term impact, whether it was demonetization or GST or RERA, IBC. All these steps were having a negative short-term impact on the economy. Now, those short-term negative impacts are out. Corporate India is deleveraged like I don't think it has ever been in the past, at least last 3 decades. So, loose monetary policies, delevered India Inc., and corporate tax cut, and growing profitability. The corporate profit to GDP, which fell to below 1%, is now rising since last 3 quarters, and it is slated to go higher. In that kind of a scenario, one has no choice but to stay bullish from a medium-term point of view. But having said that, the odds are not the same they were in March. One cannot rule out a 6-month kind of a correction consolidation, and whether it is a rotating one or it happens across the market remains to be seen.
Yeah. So just one quick follow-up, Ravi. The first Alpha Moguls that you did with us, you had mentioned that you'd use the term we, but essentially speaking about you and your breed. You're so focused on stock picking and money making that at times you lose sight of the macro. And it's when the macro comes and slaps us hard is when we realize that, oh my God, this should have been paid heed to. You don't foresee such an issue as things stand right now, valuation-wise also.
I absolutely agree to that point. Yes, we still have one eye on the macros as well as the valuation, but I don't think it is panic quarters yet. And one should still be focused on stock picking. So I think markets were behind the curve in anticipating the kind of profit growth that was on the horizon. I mean, you can see from so for last 8 years, the earnings estimate were constantly being, we were getting disappointed, and the earnings estimate were hardly being met. For the last 3 quarters, the surprise on the earnings estimate is so huge that it has never been such a big surprise in the estimate. So clearly, market was behind the curve in estimating the profits, and those profits are now coming through. The fundamentals still remain strong. Probably, market might have moved now a step ahead of the fundamentals, but there is nothing to say that fundamentals are going to turn for the worse, or that markets are so far ahead that there is a kind of a capital destruction kind of risk on the horizon. And the biggest factor I'm again pointing out, India Inc. is deleveraged. The utilization levels are yet to reach a level from where they start announcing huge capex. The economic cycle, once put into motion, it is difficult to pull it back. I mean, if this profit cycle continues for another 2-3 quarters, you will see spate of announcements from across sectors on capital expansion, and that will be the sign. The corporates need that 6-8 quarters of profitability under their belt before they start announcing expansion, and we can see that in a couple of quarters, but it will happen across many more sectors. Just to add to that, this government's policy of PLI, the production linked incentive scheme, I think is just providing one of the best environment there has been for a corporate. Not only are we restricting imports, we are also providing support domestically to achieve scale. Now, this is, as Nilkant Mishra has already pointed out, this has never been the case. We have always incentivized remaining subscale. This is the first time that companies are being incentivized to achieve scale. to become globally competitive. So this will have its impact. Today, 2-3 sectors are off the track, but in due course, about 12 to 15 sectors will be in the same race, and there will be champions emerging out of each of those sectors over the next 5 years.
Yeah, that'll be beautiful to see, frankly. I mean, and plus the fact that it's production linked. So it's not that you're giving an incentive for setting up a factory and then you don't, I mean, then the person is not accountable. You're taking the benefit, you produce, you give employment. All of that is just fabulous. Let's see how it works. It's working well for the mobile phones thus far. So Ravi, therefore my question is, how are you, if you're not worried about a macro scare, or you don't believe that valuations have turned so out of whack that it should worry you, my question to you then therefore is, how are you playing, if I can use that term, your portfolio currently? Is the portfolio currently tilted towards the tried and tested, beautiful names but maybe with rich valuations, or are you going for value? Because traditionally you are a value investor as much as I know you. And within that too, are you going for the unlocked trade now that we've been in about a month and a half of lockdown, and we might very soon be out of that? And that is where actually there are bombed out valuations, if you will. So what's the current portfolio or stock picking strategy?
Right. So just to put a little bit nuance to the outright bullishness that seemed to be coming out of the conversation, I am not saying that there are risks at this point of time, and the risks are more of you overestimating or extrapolating the current trends into the future, or you taking a bet on a company that it is not everybody's cup of tea to scale up. So there will be few winners. Not everybody is going to remain a permanently good investment. So you need to be very careful about the stocks that you pick going forward. Having said that, because the profit cycle is improving, corporate profit to GDP, which went below 1% in March of 20, is now probably between 2 and 3%, and is likely to rise to 5 to 6% and probably exceed the previous high of 7% in 2000. That was made in 2008. It will exceed in the next 4-5 years. So when the profit cycle is rising, it so happens that the pie expands, as well as the number of sectors that are participating in it also expand. So the opportunity from that point of view is expanding. 3 years back, and I mean, there were 10, 12, 15 stocks that were doing well, and only those companies were being touted as the quality, and those were the stocks to focus on. But now you can see if the number of companies that are reporting fantastic results is probably run into hundreds, if not almost like 200-300 companies would have given fantastic results, and the absolute valuation was very, very cheap. So the opportunities are there, but the risks also are there in terms of you have to be really correct in your stock picking. It is not that you go and blindly place a bet on the last company that is yet to perform in the sector and suddenly that will start doing well. There is a risk of you probably giving too much importance to the near-term profits. There is a risk of little bit of valuations if it is a cyclical and not a structural theme. So you need to be very sure of the sustainability of earnings, the quality of earnings as well. So I'm sorry, I forgot the second part of your question.
No. So you actually answered my question very well, Ravi. Let me do a follow-up to that now. So therefore, the follow-up is that if indeed at the current juncture it becomes so important to be able to pick the right player, even within themes which are doing well, can I try and ask you about a few themes, and maybe you can illustrate within that theme if you already have something in your portfolio or you like something, etc., just from an illustration perspective, because I would love our viewers to understand how is it that you are thinking about going out and picking those stocks. Now, a standard disclaimer, viewers, to all of you who are listening right now, whatever Ravi says, he may have bought it in his portfolio or his client's portfolio 6 months back, 9 months back, 12 months back, or yesterday. We are not going to get into that conversation. This is not a stock picking forum. This is essentially just to try and understand how is it that he's thinking about the themes. Ravi, if that is fair enough with you, can I ask you about a few themes?
Sure. Thanks for that elaborate disclaimer, and I'll just add my bit to it. It is safe to presume that we have vested interest in all the stocks that we might discuss. It is purely for illustration and example purpose, as a case study, and not any kind of a recommendation.
Okay, so let's talk about unlock, right? Unlock, if indeed we believe that the unlock theme will play out over the course of the next 2-3 months, BFSI, autos, real estate, what have you, the three rate sensitives. How are you going about judging these? Are there companies within that or ancillaries within that you are betting on? And give us an idea about how are you honing down on or narrowing down on a particular company?
So I think, Niraj, when we spoke the last time around, at that point, I was a little skeptical on the financials. I was actually worried that essentially the NPAs were the balancing factors. Whatever losses could not be borne by the entrepreneur or the government or the in cost cutting will all be passed on to banks, so to say. But what we have seen is that the profit cycle ended up being so strong that the banks did not face the kind of NPA issue that one would have expected. And that is also partly due to the fact that most of the India Inc. had actually deleveraged prior to that. And most of what RBI did beautifully was make sure that the banks capitalize themselves properly. So combination of the factor that the bank's balance sheet were properly capitalized and the NPA cycle didn't turn out to be. I remember, Uday Kotak making a statement that the banking system is about 100 lakh crores, out of which 4 to 5% is likely to become an NPA. Now that was an estimate of 4 to 5 lakh crore, or so instead of that 4 to 5 lakh crore, we're probably going to end up closer to a lakh crore or maybe just above that. So that is the huge change that happened, and that is why the financials rallied fantastically from September, October onwards. So now again, if the unlock trade was to pan out, the first trade usually is the financials. An economic boom is going to be preceded by a boom in the credit cycle. So we are not yet seeing the credit pickup the way it should happen. It is still at an aggregate level. It is still only 6-7% kind of a growth. But if you go scratch beneath the surface, you can probably see that corporate sector lending is probably upwards of 10-12%. The good banks are willing to grow, already growing at 12-15%. So that tells you that the corporate lending cycle is coming back. And I believe financials would be a good way to play the unlock trade. And it ties in very, very well with the first point that I made, that I don't think we are going to witness a third wave. So if that is the case, and in 6 to 9 months' time, we are going to have a fully functioning economy, I think markets will be willing to see through the next 3 to 4 months of difficulty and discomfort and start focusing on what happens when the economy opens up. So I would definitely prefer financials to play the opening up. There are other businesses like restaurant, tourism, and travel. Those are all the most impacted sector, but there are not too many plays available on in our markets to start betting on those. So I think the best proxy for the economy rebound remains financials.
Okay. What about real estate? How does one do that? Because that's a sector that has got tremendous, how do I say, impetus in the government as well, right? Not only is RERA out there and maybe hopefully effective, but the stamp duty cuts, etc., and all of that. So do you play pure play real estate or do you play ancillaries? And I believe you probably have some ancillaries in your portfolio as well. So can you tell us a bit about how are you going about analyzing this?
Right. So yeah, thanks for pointing that out. Real estate is definitely something that we are bullish on. But our reason for bullishness is not purely, so to say, opening up of the economy. There are many things that have happened in this particular sector. So this sector went through a GST demonetization, RERA, IL&FS crisis, and then add to that COVID. So there have been like one crisis per year in the last 5 years for this sector. And if a company has managed to survive all of those, then that speaks volumes about that particular company. The consolidation in this particular sector is the highest amongst most sectors. I think the competition is reduced to the extent of bottom 50-60% of the market, the competitors being wiped out. And you can see that in the new launches that are happening. Even though there is stimulus being given by state government as well as central government to revive the real estate sector, the new launches are being announced by very, very few players. There is still a lot of inventory left that remains to be absorbed. But I believe if this current pace of absorption sustains, then in 18 to 24 months' time, I think we'll have a new boom in real estate also pending. And usually, stock markets tend to lead the real estate boom. But real estate boom tends to stay longer than the stock market boom. So, coming to how we are playing it, I believe we believe that the better business models or the better risk reward was available in some of the ancillary sectors, the building materials, the home improvement sector. So if a sector has grown at double digits in the worst of period, then you can imagine what happens if the times are going to be good. That's exactly what's happened in the pipe sector. So the last decade's growth rate in pipes was 15% CAGR. But the first half of the last decade was 20% growth and the second half was 10% growth. So now if the real estate actually picks up, at least in volume terms, then we can hope that the sector can grow at somewhere between 15 and 20%. So if sector is going to grow at 15-20% and the number of players are reducing even in this particular sector, so the top 5-6 players like Astral, Prince, Ashirvad, Finolex, Supreme, these are some of the players that are taking away the market share, not only from the absolute unorganized player, but also from some of the organized players who have gotten themselves into trouble because of their real estate exposure, like Jain Irrigation, Skipper. There are many such examples where the players are literally sidelined during this boom. And coming to there is also the added tailwind of the government focus. There are a couple of schemes of government that aid this sector. For example, the Jal Jeevan Mission and the Atmanirbhar. So the duty that is being imposed on the import of PVC is resulting in the supply chain disruption for the smaller guys, while the larger guys have their supply chain secure and they are able to pass on the cost increase as well. This is leading to not only a fantastic growth, but a big boom in the big expansion in the margins as well. So clearly, real estate there are many ways to play real estate. You can play it through a financier, you can play it through a home improvement. We actually picked up a couple of home improvement plays.
Yeah. So I know, just wondering, a quick thought, and I don't know, if you may choose not to answer this, Ravi, but I'm still asking you because I know that you guys bet on Prince Pipes. There were multiple other companies available, right? Astral, Supreme, a smaller one like Apollo Pipes, which is using the APL Apollo infrastructure. Why choose a Prince? I mean, I'm just trying to understand the logic behind choosing a particular investment.
So clearly, Astral is the leader, and Astral is the AAA rated player in the sector. Obviously, but one of the dharma of investor is also to assess the odds. The odds or this particular bet was so mispriced in favor of Prince, as in it was available really at a throwaway valuation. So Astral is probably kind of in a league which is above Prince, but at the same time it is not so much apart that you value the next best competitor at 10% of its valuation. So Astral was available at 26,000 crore market cap, which is probably now moved to 30,000+ crore market cap, while Prince was available at closer to 2,000 crore market cap, and today it is closer to almost 8,500-9,000 crore market cap. So this is something that we have done in the past also. In way back in 2010, the similar kind of mispricing was there in Exide versus Amar Raja, and a number 2 player, which is half of the number 1 player, was valued at 1/10 of the number 1 player. and then you saw that market share was actually being gained by the number 2 player. So in this case also, Prince is actually quite beautifully positioned because they did the IPO at the right time, where they deleveraged themselves and they put up the capacity. It is one of the only players that is going to have the benefit of expanded capacity over the next 12 months. Also, the fact that Lubrizol tied up with them gave that added booster and benefit in terms of branding, in terms of supply chain security, in terms of improving their product mix towards CPVC. So in this pipe sector, essentially what you're trying to bet on is the CPVC, where Astral has the superior product mix. However, Prince will have a faster growth, better improvement in the return ratios and cash flows, and there was also kind of a negative perception about the company because of some past corporate governance issues. So there were all good reasons why it was available at those valuations, but now incrementally those issues are being put to rest, and that is why market is actually re-rating and reducing the gap between the two players. And that is our rationale for picking the strong number 2 players versus the identified number 1 player.
Yeah, but the beauty about this is that it gives an insight into how the same theme could, or the same strategy could be deployed in so many other places as well. Ravi, you have a very good handle on pharma. I mean, I'm not saying you don't have a good handle on others, which is why you're doing what you're doing with your portfolios. But in pharma in particular, I've seen you over the years pick out some terrific winners. How are you viewing this space currently? Because not only it's divided into multiple facets now, with healthcare being such a large pocket and diagnostics, hospital chains, all of them gaining prominence because of COVID. But within pharma too, this whole big distinction that has happened between, say, I mean, if I can use that term, pure play pharma companies, established names like Sun, Cipla, Aurobindo, etc., versus the API players who are also doing other businesses, CDMO, stroke biologics, stroke others, and the stock prices are there for everybody to see. The gains have happened too. So make it simple for us. How are you, from the current juncture, watching pharma? What is it that you believe will create wealth? And again, strictly, I'm not getting into a point of where did you buy it. I'm just trying to understand, how do you see the wealth creation opportunity here on?
No, point well taken. Absolutely. So pharma is not the homogeneous sector that everybody believes. There are pockets. There are pockets like API players available. There are biologics play available. There is a US specialty complex play, specialty generic play available. There are domestic pharma players available. So it's a mix of a lot of different types of opportunities that are out there in the pharma space. For what we have bet on in the last year or so is, one is obviously the revival in the US generic market, and second is we have bet on Indian API players who are either graduating to becoming a formulations player, or they are increasing their dominance in the API players play itself. So this actually flows directly from our earlier one of the earlier themes that we played, which was a specialty chemical, and we could see that happening in the API as well. So finally, APIs are also chemicals, and the supply chain. The difference between the supply chain was in specialty chemicals, Indian companies were focused on niche opportunities, while the scale and mass scale was being addressed by China. In API, the difference is the advanced intermediates, and the key starting material is what the China was addressing, and the late stage APIs and formulations is where India is strong. So this particular area was clear to us that API companies in India will have a huge tailwind going forward, because India wants to reduce its dependence on China. Not only India, the world wants to reduce its dependence on China in terms of the key starting raw materials or intermediates. And even China wants to reduce its dependence on polluting sectors, or they want to let go of the bottom 5%. So China has about 35-40% of the world's market share, and they are willing to let go of the bottom 5-7%, to retain their higher level dominance. So, but for a country like India, which is 3% of the world, a 5-7% market share shift is like doubling or tripling of the sector. So that's exactly what is going to pan out, is already happening and is going to pan out. Indian players are going to backward integrate, and they are going to not only manufacture for domestic purpose, but they are also going to supply to the world more and more. Indian players will go from being number 2, second vendor to the world, to the big pharma, to being the lead supplier. So more companies should, we'll see champions emerging out of this space as well. And in absolute terms, these companies were available at really cheap valuations. Whether it is, I don't think there is a single player barring a Divi's which is of any size, and I think that is the reason that got us excited on the API plays. On the US generic revival, the pricing erosion had kind of stopped since 2018-19, and due to COVID, there were some shortages also created, and price inflation actually became, and it also provided some added demand of new products like remdesivir and favipiravir, and suddenly these products started contributing to the players. So this growth came out of nowhere. There was a perception about a year and a half back where Indian generic was being denigrated, that is a bottle of lies, and we don't follow the ethical and standards that are required for manufacturing. I think, if some investor paid heed to it, I think he would have kind of lost out on a golden opportunity to visual. What was going to happen is what is already happening, which is we are now providing the vials of life and no more bottles of lies, and we are now the pharmacy to the world. So clearly, Indian companies have a big role to play in the pharma chain across the world, and it is here to stay. Apart from IT, pharma is one sector where India has some global dominance and competitiveness. So there will be winners out of this, and one has to keep their eyes and ears open for those opportunities.
Okay, but you prefer API players more? The LAURUS's and some of the others, or do you think that there are other opportunities which are better?
Yeah. So just give me a second. Yeah. So it is not preferring one over the other, but
okay.
Yes, LAURUS is something that we picked less than a year back. Yeah. So we did pick. So again, sorry, disclaimer. Our clients and we might have interest, and we might act contrary to whatever gets discussed over here. So the point being that this,
I just want to understand, Ravi, why a LAURUS? Forget. It's not a recommendation from your end. Just let's try and understand. Yeah.
Right. So I happen to know Mr. Chava Satyanarayan from the days of Matrix Labs, and Matrix Labs was one of our investment way back in 2004-05. So we knew about his capabilities, and he took a break in 2006-07, did a 2 years MBA at ISB, and then he set up his own company. We had been tracking his progress as a company. There were private equity players who had funded him, and yes, he had leveraged himself personally and the company to achieve the scale that he has today. So now, see, the problem most of the people had with LAURUS was the excess leverage, and at that point of time, the capacities stayed unutilized, and they were carrying a lot of OPEX, which was actually understating the profits and the profitability. So once it became clear that the capex and the debt had peaked, and the COVID provided the impetus for that extra boost, there was one particular drug, DTG, dolutegravir, in antiretrovirals, which was becoming the standard of therapy in AIDS, and it was replacing an old product of theirs. So the kind of adoption and the kind of pricing that they got in this particular product, gave them this fantastic boost in profitability in the last few quarters. Having said that, that is not the only engine that they have. Now they have built in other engines as well. See, when you are picking an API players, what you need is somebody who is good in their processes, who can cut down on cost. There will always be pressure on the cost, but you have to be ahead of the curve in terms of doing custom synthesis and process chemistry, cutting down on the process cost, and in fact passing on voluntarily your cost savings to the your clients. So why does so if I were to give an example of Divi's has complete dominance in the 5-6 molecules that they have. Nobody can match their pricing. They have nearly 60% kind of even more probably price market share in naproxen. Similarly, LAURUS was also built along those same line. The kind of cost structure that they have and the kind of cost savings that they do for the client is leading to them having 30, 40, 50% kind of market share in huge molecules in volume terms. So what you need when you're picking an API player is the ability of the player to demonstrate their, that they can dominate a particular market. So that is what excited us, and markets were worried about the leverage, and we were sure that all they need is one good year and the leverage will be down to a very manageable level. And it also provided us with an added confidence that the promoter himself had leveraged to buy his own stock. So that gave you a lot of things, that he truly believed in his own company and the opportunity. And we still don't know how this story will evolve. Today they are still dominated by APIs and antiretrovirals, but tomorrow the story could be biologics. It could be 2-3 years away, but it is he's already demonstrated that he can scale up. He can scale up the business, and I think that is a trait that I would look for in companies where you believe that small company is going to become really big. I think LAURUS has demonstrated that.
Okay, so maybe viewers try and go around looking at businesses and entrepreneurs who can do that, and of course within that right space. Ravi, final couple of things, and no conversation about pharma can be over without talking about the ancillaries, right? And now we hear a lot of companies trying to speak about pharma grade supplies, and it's said with pride, and it's almost spoken about in a way that it gives that company a slight edge, some pricing power, some specialty status. It's happened in chemicals, as you and I both know, but GMM Pfaudler speaks very proudly about it, about pharma and chemical grade supplies. The other day we were talking to Raj Industries, and you must be knowing because it's one of your portfolio companies, but they are talking about supplying in a big way to the pharma space as well. How do you look at the ancillary space? It's a very wide bucket. What do you like here? Anything present in your portfolio that you can talk about? How did you go about and
sure. So
buy that?
Again, a disclaimer that it's a stock that we own, and it's been fantastic.
Which one is this?
Praj Industries is one stock that we own. However, we do not look at this company through the lens of pharma ancillary, so to say. I think there are many engines. See, this particular company, again, I have a history with this particular company since the earlier cycle. When I used to work at Rare Enterprises, and Rakesh ji had invested in Praj. At that point of time, we had this ethanol cycle, and there was a huge debate of food versus fuel. And at that point of time, crude had gone to $200, and then it collapsed, and it looked like that ethanol story was done and dusted and buried. But what this company did, it pivoted from being an ethanol company to focusing entirely on R&D on sustainable materials. So it has many R&D projects running, whether it is bioplastics, whether it is marine biologics, whether it is high purity grade pharma intermediates, or for that matter ethanol or compressed biogas. So this company spent the better part of the last 10 years spending nearly 40% of their profit on R&D. That just shows you that most people confuse this as an ethanol play, as a play on sugar cycle, or as a play on equipment being the shovel seller in the ethanol opportunity. But this is a company that has an R&D DNA of an R&D company. So I have no way of telling you which products will succeed and to what extent. But all I can tell you is that they have seeded a lot of possibilities, and which possibilities eventually do materialize and to what extent remains to be seen. But even at this point of time, if we just focus on ethanol and compressed biogas as the two opportunities that are likely to materialize over the horizon of 3-4 years, then the stock was available at, again, sub 2,000 crore kind of a market cap. So and again, I mean, what we are going to witness is that at least 20,000 crore kind of opportunity is going to be panning out in the next 2 to 3 years. I don't know what kind of market share Raj will eventually end up getting, but that is the kind of addressable opportunity for them. Once you have identified an opportunity that is so large, and a company that is barely 2,000 crores in size addressing that opportunity, then you have to give it a long runway. You bet on it and see how things pan out. Things are panning out better than expected for us at this point of time. But again, very exciting times. The kind of product, and I think last week there was one particular announcement where they spoke about making bitumen from sustainable material. So again, essentially, this company is doing a lot of good for the world. So you want them to succeed. It is truly a sustainable company in that sense.
Yeah, that's true. And I think the analogy is great, that if the market cap is so low and if they have a large addressable opportunity, then that's great. But just before we wrap up, Ravi, my final question would be this, that still I'm trying to understand that what about the pockets which are addressing the complex ecosystem? So I call pharmaceuticals a bit of a complex ecosystem because it's irreplaceable, very critical, and there are places and companies which are contributing to that. There are companies, for example, I mean, we are a digitally connected world, and there are companies which are servicing that side of the bucket. And I'm not talking about traditional IT services, but new. So whatever within that, pharma, IT, telecom, what have you. But what about the servicing companies or companies which are not in the principal business, but doing this? How do you go and pick out winners and losers there?
So clearly there is a dearth of opportunities in the digitization space that you're talking about. But digitization as a theme is here to stay. And today, here we are doing this interview over the Zoom call. I don't think 18 months back we could imagine that. And all the businesses, and I said in the second wave, the businesses are doing just fine. Supply chains are not disrupted. Again, it is a large part due to the fact that business can be conducted over mobile and Zoom calls, and the physical and the logistics part is reduced to the bare minimum. So digitization theme was already present even prior to COVID hitting. But what COVID did is it accelerated it. What Satya Nadella said is essentially whatever was to happen in next 2 years got done in next 3 months, or what is going to happen in the next 20 years is probably going to be bunched up in the next 2 to 4 years. So and the beauty of the business models around the digitization is that they are low capital. Their capital requirement is low. It is a transaction-based fractional transaction-based business model. So for example, one of the player that we own in the CPaaS place, which is communication platform as a service, is Route Mobile, and they are for every transaction that you do online, whenever there is a two-factor authentication, or whenever there is some kind of a communication from a business to you on WhatsApp or SMS, there is a third-party platform involved in sending you that message, and they are getting paid 10 paise to 1 rupee, depending on what service and what kind of technology that they are using. And there are billions and billions of transactions happening. This is the kind of quasi play that you would have for companies like Amazon, Google, WhatsApp, or Microsoft. All these companies are growing digitally, and their target opportunity is 7 billion people. They are not thinking in terms of geography, and these guys are kind of attached to that particular company's growth. So they don't have the time, or they don't have the competency to go and deal with 200, 300 telco providers worldwide, and negotiate a price and provide or create their own platform. So that's why this third party vendors of platform service providers exist today, and it's a space that is growing very, very fast. And we have seen this story play out in US, whether it is software as a service, or for that matter, so many other as a service model are there. And I believe not only the company that we have bet on, but over the next 12 to 24 months, many more companies from private space will be entering, and those will be exciting opportunities. Now, obviously, you are not going to get those companies cheap, but it is going to be, there will be some winners even out of those overpriced technology play that will be coming for IPO. So you need to do your stock picking over there as well, because there are some business models that you have to, again, the benchmark remains the same. You have to see what the addressable opportunity is, and whether this particular player has a competitive advantage, and what is the absolute valuation you are getting it at. And if you see that the risk reward is still in favor, then it would be a good time to go ahead and bet on these business models.
Just final question, Ravi. And since you mentioned risk reward, I think it's pertinent. I'm sure you also want to talk about this. Is that when the valuations would have been very attractive for some of these names, when you might have picked them? I have no idea about that. But how do you decide when to sell, or when will you decide when to sell these? Would it be a factor of valuations having become very, very expensive, and because of the run-up that has happened? Or is it something around the management not executing well? I know it could be a combination of a lot of factors, but what would be the single biggest factor? Because in most of these companies that you've spoken about, or maybe some of your other peers would have bought in, the run-up at times has been very, very swift, as was the case in Praj last month, as was the case in Root Mobile maybe earlier in the year, or was the case with LAURUS Labs for the last 12 months. So how do you decide when to get out of these companies?
No, I think that is a very, very pertinent question, and that is something that we struggle with on a daily basis as well. So, but one thing is very clear. See, do not get swayed by the current PE multiple. A lot of people, it's not like we are not paying heed to it. For a company, let's say like Root Mobile, it's probably trading at a multiple upwards of 50. But if the growth, last year's growth was 54, 55%, and if the next year's growth is anywhere close to that, then you will see that these multiples are not going to contract in a hurry, as long as the growth sustains. Now, it is always a difficult call that how long is this growth going to sustain, and when it is going to taper off. So the model or the framework that we use is that we keep comparing the opportunity from a rolling 3 to 5 year point of view with the valuation that it is being trading at, absolute market cap valuation that it is trading at. So for example, if the global CPaaS opportunity is a $60 billion opportunity, and it is growing at 30%, and this particular player is available at $1.5 billion, and there is a possibility that they can be in the top 10 service provider of the world, I think there is still a large scope available. Now, this large scope needs to be proven by them delivering on the growth front every now and then. The growth can be organic as well as inorganic. So they have the balance sheet. In fact, they have a stated intent of going out and acquiring new technologies, acquiring clients in new geographies. So the space remains large, and this company can still remain large. So getting scared by the current valuations, current earnings multiple will probably be a disservice, and one should stay focused on a 3 to 5 year rolling absolute opportunity size. I hope that answers your question.
It does, Ravi. And in fact, in this whole show, there is, as much as we've used examples to explain the points, I think some of the investing philosophies have turned out really well. So thank you for that. I wish you a lot of success and safe health, Ravi, to you and your team and everybody around. And thank you so much for joining in today and giving us some of the thoughts about how you're structuring your portfolio.
Great. Thank you so much. Thanks, Niraj.
The pleasure was ours, Ravi. And viewers, thanks for tuning into this edition of The Talking Point.